Hey guys, so Tesla just released their earnings for Q1 2022, and just based on what Tesla stock is doing this morning, you could definitely see that the earnings were nothing short of amazing. So today in this video, I'm going to be talking about the most important numbers that we saw from the financial reports yesterday, as long as some interesting tidbits and things that we might have learned from the earnings call last night. So me, like everyone else, the first thing that caught our eye was a huge beat in EPS, earnings per share, of $3.22 versus the analysts expected about $2.20. And EPS, or earnings per share, are one of the biggest metrics that the analysts on Wall Street use when valuing a company. It just shows how profitable a company can be based on its current valuation. We saw for the first time 30% gross margins excluding regulatory credits, and about 32.9% gross margins when you include regulatory credits. 19% operating margin versus 15% in quarter four just 3 months ago. And just remember that operating margin is the money that you're taking home after COGS, or cost of goods sold, and operating expenses. Cost of goods sold examples could be, the cost of labor to actually build these vehicles and the price of the raw materials. Operating expenses are more closely related to overhead. How much does it actually cost to keep these employees, insurance, workman's comp, rent on certain buildings, stuff like that. Revenue came out to be $18.76 billion versus quarter one in 2021, which was $10.3 billion, which was a staggering 81% increase year over year. I mean, honestly, is there another company as large as Tesla that's growing as fast? The cash flow came in a little bit lower at $2.2 billion versus $2.7 billion in the previous quarter, mainly due to ramping these new factories and a lot of the costs associated with opening up these large gigafactories. Net income of $3.3 billion versus $2.3 billion in quarter four. And people are wondering how Tesla somehow increased their profitability and their net income despite not raising as many deliveries, where we had 308,000 deliveries in the last quarter versus 310,000 in this quarter. And just going to what Elon always says, that
the best part is no part. The best process is no process. It weighs nothing, costs nothing, can't go wrong. So
the best part is no part. The less you need to actually run the business, the better. For example, the GigaPress that was created by the company Hydra. These things are effectively being used to build the Model Y within 2 parts. Why is this substantial? Well, previously, without the GigaPress, to build a Model 3 or a Model Y, it would take about 170 different parts. And that means expenses for labor costs for individuals who have to put these parts together, as well as robots to weld all these parts. Just the overall impact of reducing 170 parts down to 2. Getting rid of little details and little parts that are not needed in the all fund the entire operation and creating a more profitable business at the end of the day. And just like that, showing a net profit of $3.3 billion, the PE ratio has dropped from 197 down to 133. We could see that it dropped substantially down to about 87, which is the lowest in Tesla's career. So what is PE ratio and why is it important? PE ratio, or price to earnings ratio, is a metric used by investors to essentially pay for future growth in a company. The higher the PE, the more projected growth a company has. When a company has a lower PE, it's the likelihood that it's already hit its growth phase and is now somewhat plateauing and not hitting that exponential S-curve as Tesla is right now. A company like Apple has a PE ratio of always between 10 and 30. For companies growing as fast as Tesla, it's not uncommon to see PE ratio as high as 1 to 200. And it's crazy to think that just a year ago, Tesla's PE ratio was over 1,000, and within 1 year has now dropped to close to 100. But just doing some quick math, if you take the net income for the entire year and multiply it by the PE ratio, you get the total market cap for the company. So let's say Tesla's net income is about $3 billion, that means $12 billion by the end of the year, 12 billion in profit, and you slap a 100 PE ratio to that, and you have a $1.2 trillion company, which is almost reflected directly into Tesla's share price to be about $1,200 a share. The average sale price for each car has risen, mainly due to price increases due to inflationary environments, and mainly due to prioritizing the long range and performance variants on the Model 3 and the Model Y. Especially given that the Model Y has been ramped substantially, even though that the Model 3 and the Model Y are virtually the same costs when being manufactured. They're able to sell to consumers for at a 20% price premium for the Model Y, which all leads to increased profitability. And the last piece of news before we go into the earnings call is their total debt. In the last quarter, they have effectively paid off their last $1 billion in recourse debt. Recourse debt relates to any loans that they may have on their vehicles or their factories. So it's amazing to see that they really have just a small amount of debt left. and that their net cash on hand is close to 20 billion, which puts this company in the strongest financial position that it's ever been in. And it's actually even bigger than that. So now, I was first made aware of this by Gary Black on Twitter. Great person to follow, really good information. Seems like he never sleeps. He's up at 5 a.m., putting out estimates for his Tesla price targets. Gary estimates that the S&P is very soon going to be looking at Tesla the business and possibly upgrading it to what's called investment grade. Now, they have a grading system based on how risky or how safe a stock actually is to purchase. And there are some limitations for some firms or institutional investors or even some pension funds that they can only allocate money towards investment grade stocks. Stocks that have very little debt, very good income, and very good cash on hand. So once the S&P reevaluates Tesla and does upgrade it to investment grade, that's a whole new market and whole new money that's going to be funneled into Tesla stock. So those are the big numbers that I wanted to go into. So now we're going to go into the earnings call, and I'll give you a couple of highlights. So if you like this video, be sure to like the video, comment down below if you want to hear of anything else or any other topics that you want me to venture into in the future. But with that said, thank you so much for watching, and I'll see you in the next one.
We remain confident of a 50% growth in vehicle production in 2022 versus 21. I think we actually have a reasonable shot at a 60% increase over last year. With new factories, the initial ramp always looks small, but it grows exponentially. So, but I have very high confidence in the teams in both factories, and we expect to ramp those initially slowly, but like I said, growing exponentially, with them achieving high volume by the end of this year. A dedicated robotaxi that's highly optimized for autonomy, meaning it would not have steering wheel or pedals. And there are a number of other innovations around it that I think are quite exciting. But it's fundamentally optimized for it's trying to achieve the lowest fully considered cost per mile or cost per kilometer, counting everything. And so it's, I think, going to be a very powerful product where we aspire to reach volume production of that in 2024. We aspire to head to 20 million units a year. So we're basically 5% along the way towards our goal. So 9 to 12 months from start of production. So now hopefully we're getting better at that ramp. So maybe it's a little less, but to get to sort of the 5,000 a week level is typically taken us around 12 months from start of production.
One thing I want to call out is, like, we're also, committed to recycling at all of our cell factories. We're recycling 50 tons a week right now in Reno and ramping to 150, with all of that reclaimed material going directly back into our cathode supply chain. So we're looking at the beginning and end of life needs here.
Yeah. And that's true. Like, since Reno, we built Gigafactory, we started doing that with batteries. But as we built newer factories for vehicles, for example, Giga Texas here, where we are today, recycles all of its non-yielded or scrap aluminum from the stamping shop directly into the casting shop. We regrind any plastic that goes out. And so we're really concerned about raw materials, not just like mining them and consuming them, but when we get them in the door, using all 100% of them.
At Giga Texas has both a front and a rear body casting. So we're casting almost 2/3 of the body. Then it's high pressure die cast aluminum. So we can take both scrap from the casting machine and the gating that comes out and put that just really toss that back into the aluminum melting pot. And then, as Lars was saying, also take any stampings and any other aluminum scrap and also throw that in the melting pot. And in fact, we've also figured out that we can use wheels from practically any car.
Make your wheels.
Yeah. So we're going to be recycling the cast aluminum wheels from legacy gasoline cars as well, and throwing that in the melting pot. I think inflation is at like a 40 or 50-year high. And I think the official numbers actually understate the true magnitude of inflation. But looking at some of our projections, it would appear that a robotaxi ride will cost less than a bus ticket, a subsidized bus ticket, or subsidized subway ticket. The lithium margins right now are practically software margins. I mean, if the Zach, correct me if I'm wrong, but I think we're seeing cases where the spot lithium price is 10 times higher than the cost of extraction. So not like we're talking 90% margins here. Can more people please get into the lithium business? Do you like minting money? Well, the lithium business is for you. We hope we don't need to increase the pricing further. The current pricing is anticipating what we think is the probable growth in costs, and if that growth in cost does not materialize, we actually may slightly reduce prices. So we don't currently anticipate making significant price increases. But obviously we don't control the macroeconomic environment. If governments keep printing vast amounts of money.
I was wondering, in terms of number of parts, how would Cybertruck compare with a traditional pickup truck in terms of number of parts?
Like if you want to go down to depends on what you kind of part. We still have cells, and they're still 1,000 cells. But if we
that shouldn't count.
If we don't count that, the simplicity of our structure is significant versus a traditional pickup truck or any other vehicle. As we've talked about, their giga castings, we save hundreds of parts there.
I mean, the entire rear kind of half of the car is one casting.
And even still with the Cybertruck and the doors, for example, we have an exoskeleton design where the door is ready to take, and it takes all the side load from impact. So we really have we don't have the door reinforcements, we don't have the crash and shooting beams. Our architecture is always moving to reduce complexity, reduce parts, and reduce parts count. I would say, ignoring the battery cells, we're probably 20 to 30% less.
Another part of it is because we're no longer paying you, Elon, as much as we were. So I'm wondering, the extent to which you and the board are in the process of contemplating another one of these long-term compensation packages, which in the past have seemed to work out quite well. Thanks.
There are no discussions currently underway for incremental compensation for me.
Maybe one stat that I'll share. So Texas is our longest standing real-time insurance market. But based upon the information that we have, Tesla is the second largest insurer of Teslas in the state of Texas. And possibly by the end of this quarter, maybe early next quarter, we'll be the largest insurer of Teslas. And so, the customer reception to this has been quite positive. And I was reading social media on Monday after we launched in the 3 new states. A lot of folks were reporting their stories of saving quite substantial amounts of money relative to their previous insurance. And so we're quite encouraged by that, and we're working as quickly as we can to get to 80% of customers having access to a Tesla insurance product by the end of this year in the United States, at which point we'll pivot our attention to expansion outside of the U.S. The other thing I'll say on insurance is with these 3 new states, the model is different because we are now the underwriter and we are also now holding the risk. And so with those states, we are a fully vertically integrated provider of insurance.
That having real-time feedback for driving habits is actually resulting in Tesla owners driving the cars in a safer way. Because they can see they get real-time feedback on, okay, this is affecting my insurance rate or it isn't. And so when people can see a real-time score and realize, if I make the following changes in my driving habits, then I pay less in insurance, then they have a very a real-time feedback loop for driving for safer driving and an incentive to do so. So it is actually what we're seeing is it is causing people to drive their cars in a safer manner.
But yeah, the feedback loop is instant.
Yeah.
Right. So, I mean, we do claims management in-house. And so we receive the notification that there's an accident. We work to prepare the estimate. And we can, with the support of our customers, use our collision centers to do the repair.
Yeah.
And so it's, full end-to-end visibility and all of that. To Elon's point, we can then identify areas of cost inefficiency, feed those back to engineering teams or elsewhere, software teams, actually improve the product, which lowers the cost of insurance, improves reliability of the product. So it's a full circle.
Yeah, and it's basically the customer experience is just vastly better because if there's an accident, there's no argument. We repair it immediately, and this is as compared to arguing with an insurance company and then a claims adjuster and then a collision repair center, and this can be a nightmare basically. So we want to try to turn a nightmare into a dream with Tesla Insurance.